Do you want to build wealth that lasts, not just a quick financial gain? What if I told you the key to long-term wealth isn't about picking the perfect stock or chasing the latest trends? It's about sticking to a solid strategy, even when the market gets noisy. Sounds simple, right? But how do you actually make it happen? In this video, we shall share the top 5 investing tips that can help you create lasting wealth. From the power of compounding to smart diversification, we'll explore practical strategies that can set you up for financial success over time. It's not about luck. It's about making disciplined choices and having a plan you can stick to, regardless of market ups and downs. Let's dive right in. 1. Start early to harness compounding. Let's start with one of the most powerful tools in investing: compounding. Imagine planting a seed today and, over time, watching it grow into a large tree. That's how compounding works. The sooner you start investing, the more you can harness this power. Compounding is essentially earning returns on your initial investment and the returns it generates. Even if you only invest a small amount at first, starting early can exponentially increase your wealth. Just a few extra years of investment can make a huge difference in the final value of your portfolio. Time is your most valuable asset in this game. The earlier you begin, the more you benefit from compounding returns, which can ultimately lead to a much larger nest egg. Compounding doesn't just work on your initial investment. It works on the returns your investments generate. This means the longer you allow your money to grow, the bigger your returns will become. Starting early also allows you to take advantage of market growth cycles that you can't predict. Investing consistently from the beginning means your wealth will be growing all along the way. Remember, even if you can't invest huge amounts, starting early with consistent, small investments will still give you a significant advantage over time. Think of it as planting the seeds now so they can grow into a strong, profitable tree in the future. 2. Diversify your portfolio. Now, let's talk about diversification, the idea of not putting all your eggs in one basket. This strategy is often referred to as spreading your investments across different asset classes to reduce risk. Instead of focusing solely on stocks, think about including bonds, real estate, or even commodities in your portfolio. Diversification protects you when one sector underperforms. For instance, if the stock market takes a dip, your bond or real estate investments might be doing well and could offset any losses. The goal isn't to avoid risk entirely but to manage it in a way that allows you to ride out the storms of market volatility without panicking. By diversifying, you ensure that your portfolio has the flexibility to withstand changes in different markets. Even if one investment drops in value, others can help protect your wealth, keeping your long-term goals intact. You might be wondering how much to diversify. Well, the answer depends on your personal risk tolerance and goals. Some people prefer a more conservative approach, focusing on bonds and real estate, while others may lean heavily towards stocks for higher potential returns. Diversifying also means that you're less likely to panic when one part of your portfolio takes a hit. Instead of reacting impulsively, you can stay calm knowing that other parts of your investments may be doing well. This gives you the stability needed to weather the market's ups and downs. 3. Invest consistently, dollar-cost averaging. Let's move on to one of the most effective ways to reduce the stress of timing the market: dollar-cost averaging. This method involves investing a fixed amount of money on a regular basis, whether the market is up or down. By sticking to this routine, you're able to buy more shares when prices are low and fewer shares when they're high, ultimately lowering your average cost per share over time. One of the biggest mistakes people make is trying to time the market. That is, attempting to buy when prices are low and sell when they're high. The truth is, no one can predict short-term market movements consistently. By investing consistently, you remove the emotional ups and downs and focus on building wealth over time, rather than stressing over market fluctuations. Dollar-cost averaging is perfect for long-term investors as it's simple, automated, and keeps you on track even when the market is volatile. The beauty of this strategy is that it forces you to keep investing regularly, no matter what the market is doing. This can help you take advantage of market dips without the stress of trying to predict them. By investing consistently, you also avoid the temptation to pull out your money during a market downturn. Instead, you let your investments grow steadily over time, which is one of the best ways to build long-term wealth. 4. Build an emergency fund first. Before diving into investments, one of the most important steps in building long-term wealth is creating a solid emergency fund. Financial experts, including those at PNB MetLife, recommend setting aside 6 to 9 months of living expenses in a liquid, easily accessible account. This emergency fund acts as a safety net, providing peace of mind and shielding you from the temptation to sell your long-term investments during a financial crisis. Imagine finding yourself in a sudden financial emergency, like losing your job, facing unexpected medical expenses, or dealing with urgent home repairs. Without an emergency fund, you might be forced to dip into your investments at the worst possible time, when the market is down and your portfolio isn't performing well. Selling investments in such conditions could lock in losses and derail your long-term financial goals. Having a dedicated emergency fund allows you to weather personal or financial setbacks without compromising your investments. It provides a cushion that ensures you won't have to choose between covering immediate expenses and maintaining your long-term financial plan. Starting with an emergency fund might feel like you're slowing down your wealth-building journey, but it's a smart move. It gives you the security to invest without stress, knowing that you're prepared for unforeseen circumstances. This emergency fund should be easily accessible, kept in a liquid account like a high-yield savings account or a money market account, so you can get to it quickly when needed. It's important to keep it separate from your investment accounts to avoid the temptation of dipping into it for daily expenses. By keeping your emergency fund separate, you ensure that it remains untouched unless absolutely necessary. In the long run, having this safety net not only protects you from financial turbulence but also empowers you to invest more confidently, knowing that you're financially prepared to handle life's uncertainties. 5. Keep fees and taxes low. The last tip in building long-term wealth is one that many investors overlook: fees and taxes. While they may seem insignificant at first, these small costs can add up over time and significantly impact your returns. In the world of investing, the less you pay in fees and taxes, the more your money can work for you. Over decades, even a small percentage in fees can eat away at a substantial portion of your wealth, so it's essential to be mindful of them. One of the most effective ways to keep fees low is by prioritizing low-cost index funds or ETFs, exchange-traded funds. These funds typically have lower management fees compared to actively managed funds. Active fund managers charge higher fees because they attempt to outperform the market, but in many cases they don't. By investing in index funds or ETFs, you're passively tracking market indices, which usually means your costs are much lower. This allows you to keep more of your returns over the long term, which makes a huge difference when compounded over decades. Another crucial strategy to minimize the impact of taxes on your wealth is utilizing tax-advantaged accounts like Roth IRAs or SIPs. These accounts allow your investments to grow tax-free or tax-deferred, meaning you don't pay taxes on your earnings until much later, if at all. By using these accounts strategically, you can maximize the growth of your investments without the constant drag of taxes. Ultimately, reducing fees and taxes is about ensuring that as much of your money as possible stays invested and works toward building long-term wealth. By focusing on low-cost options and tax-efficient strategies, you'll see your wealth grow much faster over time. There you have it, the top 5 investing tips for building long-term wealth. By starting early, diversifying, investing consistently, building an emergency fund, and minimizing fees and taxes, you can set yourself up for a financially secure future. Now it's your turn. Which of these tips are you going to implement in your investing journey? Drop a comment below and let me know your thoughts. And if you found this video helpful, don't forget to like, share, and subscribe for more content on personal finance and wealth building strategies. Thanks for watching, and I'll see you in the next video.